Good afternoon and welcome to the SYNECTICS PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paul Webb, CEO. Good afternoon to you, sir.
Thanks very much, Alessandro. It's our pleasure to be here to present the interim results for SYNECTICS PLC to you this afternoon. I'll do some brief introductions in a moment, then I'll take you through the headline results. Then my colleague will take you through the KPIs and the financial performance of the business, and I'll come back and put some more colour into the operating performance and summarise at the end. There is on the presentation at the end, there is an appendix of a company profile for those of you who are not familiar with the business. We won't be going through that this afternoon, but it'll be available online for you to look at later. And we're happy to take any questions as we finish the presentation. So with that, let's get on to introductions. I'm Paul Webb, Chief Executive, been with the business quite a while now, been in this role since 2015. 2 long stints in the surveillance industry, so electronic surveillance and security has been my business for a long time, with roles across lots of areas. I introduce my colleague Amanda, and introduce herself, who's recently rejoined us. Amanda?
Thanks, Paul. Good afternoon, everyone. It's great to be here following my appointment last week. To give a little bit of background, I'm a chartered accountant, qualified with Ernst & Young. I originally joined SYNECTICS back in 2012, and I was Group Financial Controller and subsequently Acting Finance Director through to early 2020, when at that point I transitioned the remaining head office functions from the West Midlands through to our offices in Sheffield. Since leaving the business at that point, I've worked with a number of both listed and non-listed businesses, particularly on transactions, so supporting through the sale of a business and the preparation of an IPO as an example. It's a fantastic time to rejoin the business, and I'm really looking forward to supporting the business through its next phase.
Thanks, Amanda. It's a real pleasure to have Amanda back alongside me and with the business. She's really strengthened our senior management team going forward, so really pleased with that. While I'm on it, there's been a couple of other changes to the board, or planned changes to the board, announced recently. Last month we had a new non-exec director. Andrew Lockwood joined us, has already engaged with the business quite a bit. It's been up to the offices and the factory a couple of times. He has a background in enterprise software sales in the healthcare industry, so really relevant experience that can help us as we go into our next phase of growth and progress in the business. And many of you will have noticed that David Coghlan, our long-time chairman, announced just in the last few weeks his intention to retire from the board, probably by the end of this year. He's 16 years as chairman, 23 years really steering this business. I've had the pleasure to know him for most of that time, and he clearly has earned the opportunity to step back and remain as an active, engaged senior shareholder. So we expect that transition to be completed by the end of this year, but there's no specific time constraints on that. David will stay with us and support the transition as it takes. Okay, let's get on to the headline results for the last period. I mean, the headline really has to be the strong, substantial turnaround of profits against the same period last year. And we'll show you on the next couple of slides how that sort of profit transition has happened in 2 phases of cost control and structural changes to the operating footprint last year, followed by genuine organic growth and the highly geared business has shown with modest revenue increases in the period. You're seeing the profits come through very strongly in there. Really proud of the team. It's a really strong team performance to deliver this period's results. There's been a lot of headwinds. There's been certainly challenges in the supply chain that we've managed very effectively, had minimal disruption to our customer base from that. and some of the markets we operate in are clearly still subdued. And I'll cover that in a bit more detail in a while. I mean, the order book's solid. It's a similar level to this time last year. That's about 30 million. About 16 million of that is intended to trade in the remaining part of this year. So a substantial part of the next half revenue is already in the bag in the order book. And the pipeline of expected orders is, well, it's as strong as we've seen since the pandemic, really. Got strong, good coverage over the second half and into the first half of next year. But I would say probably the certainty around timing, there's more uncertainty around timing than there usually at this time of year, but in a stronger position than it has been for a couple of years. So absolutely would expect us to be able to deliver the second half results, get some more momentum going forward, and already looks quite strong and buoyant as we look into potential performance of 2023. The cash at the end of the period was stronger than we expected. It's been managed very well through the last few years. Probably an underlying cash of about 3.9 million, but the snapshot at the end of May, 4.2 million. No bank debt. We haven't had any bank debt for a while. And we do maintain a facility that's been undrawn. Some of the large projects that we win from time to time do have short-term requirements for larger bits of working capital, so we still feel it's prudent to have that around us. What we're most proud of is the strong gross margins in both businesses, both operating divisions. It's been a key strategic thing for us over the last few years to drive those forward, to get better quality earnings, to go after better margin work, and the mix of business, which I'll cover in more detail in a few minutes' time. So very pleased with the performance there as in both businesses. And as I said, we expect further progress, further improvements in the second half of this year. Typically, the second half of the year is much stronger than the first half for us, just normal seasonal events. That's been not necessarily the case in the last 1 or 2 years, where there are obviously other events in that, but we expect that to return to be the case. So we should see good second half this year. But clearly, whilst there is momentum in although there's more activity in some of the major end markets where we focus on, some of those are clearly still subdued, and so we should see significant further opportunity to recover growth in those areas in the coming year or two. So with that, I'll move on to the KPIs. I'll ask Amanda to pick those up and from that into the results.
Thanks, Paul. So revenue of 22.8 million for the half, and as Paul's mentioned, that is a modest increase, so about 4% on the comparative period. The operational gearing of the business has meant that relatively small increase in revenue has dropped down to show a good improvement in the operating results. So we can see here an improvement in profit before tax to 0.5 million, diluted earnings per share to 2.4 pence per share, and return on capital employed to 1.8%. I think it's useful at this point to point out that when comparing half one and half two in 2021, the reason for the turnaround in those halves was due to the cost savings and efficiencies that the business had implemented during the last couple of years. So this is really the first half that we're seeing that increase in results due to the improvement in trading. Free cash flow, that is a 0.4 million operating cash inflow, offset with 0.2 million of capitalisation. And total R&D spend, which is key for the business, has remained at consistent levels with previous halves. We've capitalised 0.2 million of that in the period, and the remainder has been expensed to the income statement. So in terms of revenue, we've seen a considerable increase in our systems division revenue, and that's been offset with a decline in revenues in our security division. And we'll talk a little bit more about that shortly. We're really pleased with the improvement in the gross margin, and the total group margin is 39.5% for the period, and that's compared to 35.5% in the comparative period. There's been no non-underlying items in the half, so after considering the finance costs, which relate to the deemed interest on the IFRS 16 lease charges, the profit before tax is 0.5 million, which is a considerable turnaround on the loss of 0.8 million in the comparative half. Tax charge for the period is 0.1 million, and that leaves profit for the period of 0.4 million. So taking a look at our segmental reporting here, we've seen some considerable improvement in systems revenue. That's just over 20% compared to the comparative half. When combining that with the really strong gross margins in the period, that's driven an increased operating result to 6.1% compared to the negative 4.9% in the comparative half. That revenue's been predominantly driven by increase in oil and gas revenues and gaming revenues. Within our security division, some customer-led delays there on major projects has meant that we've seen a decline in revenues. However, again, some really great performance in gross margin there, which has led to an improved operating result of 4.9%. So just moving on to our balance sheet, and I'll take a look at some of the key movements since the year end. The reduction in fixed assets is quite simply the depreciation being in advance of capital additions for the period. And similarly, the reduction in intangibles is depreciation of 0.5 million being offset with capitalisation of 0.2 million. We've seen a reduction in cash of just over 0.4 million in the half. I'll take a look at that on the next slide. And other net current assets, or our working capital, we've seen an increase there of 1.3 million. And that really is in our current assets, so in particular our project work in progress and also some in stock as well. That is due to the delays that I mentioned previously, which has meant that perhaps we've not invoiced some projects where we thought we would have got to the invoicing stage at this point, and so there's more sat in project WIP, or otherwise that we've got some items sat in our stock that we haven't currently yet been able to deliver to the customer site. Both net tax assets and provisions are consistent with the year end. That's really where we would expect them to be at this stage. And we continue to see an unwind in the lease liability as we've had no new leases in the period. And this slide looks at our cash flow for the half. You can see we have a net cash outflow, as I mentioned, of just over 0.4 million. That's driven by a cash inflow from operations of 0.4 million, offset with 0.8 million of cash from investing and financing activities. So you can see that the biggest impact in the cash flow from operations is the increase in working capital that I've mentioned. Other notable cash movements are the capital expenditure of 0.2 million. That relates predominantly to development costs. The lease payments of 0.4 million, and the 2021 final dividend of 0.3 million, which has been paid in the current half. And I'll hand back over to you, Paul.
Thanks, Amanda. So just looking at the two divisions now. Really pleased with the improved results in systems divisions, our core business, international business based on our own proprietary software technology into a number of vertical markets that we're focused on. Really good that we've seen revenue growth there. There's clearly a lot of room to get further growth or further recovery over the next couple of periods. The strong margins are great. The strong margins largely the increasing software content of our solutions, but also reflect our ability to pass on some cost increases from the supply chain. So we're really pleased with that. At 50.4, it's never been over 50% before. It's a bit higher than we'd expect to sustain. The high 40s is where we expect it to settle down. That's where we've been targeting. Those of you who followed us for a while will realise that 4 or 5 years ago we were about 40% gross margin in this division. That's been increasing steadily, period on period. And, we're very comfortable with high 40s. That's the appropriate gross margin for the business. And we've continued control over the operating costs. We targeting an operating margin of mid-teens % there, which we should be able to get to with relatively modest increases in revenue over the next year or so. You'll see that the relatively small increase in revenue in the last period has shown a big change in the operating profit. So highly geared, this business, and we'll see a good drop through as that revenue increases over the next couple of periods. The revenue in the period's not really one single big project contributing to that. It's a lot of smaller elements from a lot of work from existing customers continuing and completing some projects. The notable win during the period was that was announced was a long-term contract for National Grid. National Grid have been a customer for a number of years, but they made the commitment early this year to use our Synergy software platform across their whole estate, and this is software licensing and support for 5 years across that estate. Also should give an opportunity to generate further revenue through that period as their estate expands and continues. Also, a number of oil and gas projects that was a significant part of our business some years ago. In the current period and over the next year or so, looks like there are more opportunities there than we've seen for a while. That certainly happened in this last half, and we expect further momentum in that area as we go ahead. I look at the division regionally now, because I think that gives you a good insight into the progress that we've made and the progress that we expect to make going forward. I mentioned at the outset that we usually have a seasonally stronger second half, and that's been the case for most of the years I've been involved in the business. Certainly, I'll go bottom up on this slide. From Asia Pacific, we usually have a very strong second half weighting. The first quarter, December, January, February for us, it's usually quite affected by Christmas, New Year, but also Lunar New Year. So we usually have a weak Q1, which means that we have a stronger second half. The first half year on year against last year has obviously seen quite a substantial improvement. Both oil and gas and gaming have seen progress from the, albeit low levels of 2021 first half. But we expect the second half weighting to continue through into this year. So I'd expect to see a similar H2 increase as we saw last year in the year that's ahead. I mean, that said, it'll be some time. It'll be into 2023 before we see meaningful improvements and progress in this region. You may remember that we generated revenues of about 17 million from Asia Pacific across gaming and oil and gas only in 2019. So obviously a long way to go for recovery in this region. I expect some progress in the second half, and clearly there's room for further recovery in the year following that. Travel and doing business in the region remains difficult. It is open, we can travel, but there are restrictions and difficulties in that, which means that though we will see second half improvements, the larger projects that we're focusing on are slated for 2023 now. In North America, our activities there are almost exclusively in casino operations. Whilst they have all reopened and we have seen a year-on-year increase in the first half, again, we expect the second half seasonal weighting to come into play. So I'd expect further progress in the second half here. But we should note that some of the major casino operators, notably Caesars, Penn Gaming, and a few others, have indicated to their shareholders that straightforward recovery in the second half is possibly not as strong as they'd previously been signaling. Current economic conditions, high fuel costs, Cost of living stuff means that that they are not seeing that as straightforward as they were a few months ago. Las Vegas, for example, is heavily dependent on drop-in weekend business from Southern California, and they're certainly seeing that not to the levels that they were expecting a few months ago. In Europe, EMEA, UK business, that was much less affected than our two other regions by the pandemic. Our footprint there is much more heavily in public space, high security, transport infrastructure. A lot of those were critical businesses, critical operations, and that didn't see the same decline through the pandemic that the other sectors had done. In the core markets around public space, transportation, revenue is about flat on last year, and the uptick we've seen there is primarily due to improvements in the oil and gas market, essentially the Middle East, where we've seen not major new projects, but additions, upgrades, refurbishments in oil and gas facilities in Saudi Arabia, in Abu Dhabi, Qatar, and a few other places. So good to see some progress there. Our pipeline of opportunities in oil and gas is as strong as it's been since 2014, 2015. So I'd expect further momentum in that sector over the next couple of years. And pretty solid performance in public space and transportation. It's sort of flat year on year, but not built on a new major project, but built really on continuing work for existing major customers in that region. So good progress. Should have a strong second half on the seasonal weighting, but clearly a lot of opportunity for further recovery beyond the second half of this year. We mentioned R&D spend. It's been largely the same as the previous years. I prefer technology development, as we don't do much R. We develop solutions to meet our customers' emerging and evolving needs, focused on a deep understanding of their operations in the sectors they work in, and that will continue. The growth spend it's a tiny bit down from last year. That's just due to a few open vacancies in the business in that area, rather than planned reduction in spend. And Amanda mentioned that the capitalization was only about 0.2 million of that 1.6 million spend. That's because the work in the first half of this year has been predominantly completing and finishing off some customer projects and delivering. So you will see increased capitalization in the second half of this year as we focus more on some new features for the product set that will be released into the market next year. At the moment, we've been deploying first deployments of our fourth generation SYNG platform with some extensions into cloud-based deployment, into mobile connectivity and web connectivity, and further integrations into third-party systems. That will continue, and we've been productizing that work from those early deployments to make it applicable to a broader set of customers going forward. And saying that, we've actually increased our marketing activity in the period as well. So we started doing more online, more webinars, doing more through newsletters and mailing lists, social media, and that's had a really good uptake. Some really good progress on the content of those, and a lot of people signing up for that. Clearly important that we get the stories around the capabilities of the product platform and the deployments we've done. Some of them are quite groundbreaking, early deployments in a fully native cloud solution out to a broader audience. And so I'm really pleased that we've had a good uptake on that. Interestingly, quite a few people from the investor community have registered as well and been receiving some of the news and newsletters. Even a few have joined some of the webinars and seminars, which I must admit are quite technical. They're really aimed at either security industry professionals or end users in the relevant sectors. But having had some feedback from a few investors around the interest they have in those, but maybe they didn't quite understand some of the content. We will be evolving some of that content to make it applicable to a broader audience and potentially put it on platforms such as this. We're looking forward to doing that later in the year. And in parallel to this marketing activity to try and get the message in front of a broader set of customer prospects, it's really important for us, our existing customers, many of whom are long-standing customers, have been with us for a long time, and they get a lot of value and use out of our systems. We need them as advocates. We need them as reference sites for new prospects, new potential deployments. And so we've been really stepping up the game in terms of connecting with them. We've always done that. It's always been so important to us, mostly face-to-face over the years. But the last couple of years has meant we've had to look at other ways of doing so. So with some online tips, newsletters, a lot of direct email communication, social media stuff, we've really stepped up the non-face-to-face communication with that user community, trying to build a bit of a community spirit and some advocacy there, which is going really, really well. We've refreshed the look and feel of, not a major brand refresh, but the look and feel, modernized the look of some of this content. And some of you may be pleased that you'll see that following through into the look and feel of our corporate communication. So things like this presentation, our annual reports, etc., will benefit from that modest image refresh over the next period. Moving on to the security division, really pleased with the performance in that business over the last couple of years. You may remember that was formed from consolidating a couple of businesses that were operating in that space a couple of years ago, and generally it's performed really, really well. Real focus on trying to improve the gross margins with really looking at better quality, higher value work, and that's been progressing quite well. A little disappointed with the revenue for the half. It's a bit below what we'd hoped and expected, and as Amanda said earlier, largely due to some delays, customer side delays on a couple of major projects. There's a couple of projects that have taken a bit longer to get going, and have had some customers not ready to receive some of the product. That's meant that's been slightly below what we'd hoped in the first half. That'll correct itself in the second half, because both the projects with significant delays are moving full speed ahead at the moment, and they will complete in the year, slightly later than had been anticipated. However, with the strong control of the cost base and strong gross margins in the business, we were able to post an operating profit ahead of the same period last year. So we're really pleased with that. I talked about trying to move into sort of higher margin, better quality business, and it's really pleasing to get some wins in a government research facility, classified project, but decent margins on that, and further work with a number of UK police forces, notably City of London, and a lot of work over the last 6 to 9 months with West Midlands Police in advance of the Commonwealth Games, which is imminent. That'll be a fantastic reference site, reference project, and a blueprint for the future, where there's multi-agency application here. It's a police operated system using our Synergy platform, links into local authorities, transport operators, stadia operators, etc. So fantastic blueprint for the technical combination of systems across different agencies. And the business is underpinned by ongoing work with a number of important clients, and that will continue going forward. Funding and availability of spend in the UK public sector, which is the biggest area this business unit operates in, has still been tight, has been constrained, but there are specific opportunities and specific funding available, and we're trying to work with end users in that space to help them specify and apply for funding to allow projects to go ahead. You just go and ask for funding to replace an aging 10-year-old system, it's quite hard to get money released. But if we can bring some new functionality, bring some real benefits into those systems with elements that we've deployed elsewhere, so elements of the cloud, using the cloud to share evidence between agencies, elements of the mobile extensions to the product platform to allow people not in the control room to get connected into instant management and what's going on. It opens up some opportunities for funding around making streets safer and making systems work better, reducing their operating costs, not needing to drive down to control rooms to burn CDs of video, but share that through the cloud. So with a targeted approach, we think there's some decent opportunities for further development in the revenues in this sector over the next few periods. Okay, so that's a brief summary of the performance in the two business units over the year. Let me just summarize that, and then we'll start looking at some questions. I mean, clearly the big takeaway is the turnaround in profitability. So we're really pleased with that, that everything we did in the prior year to tighten the operating footprint. It wasn't just cost savings around lower activity, but really structural tightening of the business. We closed about 5 operating sites over the last couple of years, and business is operating really strongly from a more centralized position. So really pleased that you've seen that coming through and starting to see the gearing drop through. Modest increases in revenue will make significant difference to the profitability of the business going forward. And good to see resumption in the revenue growth in the core business, in the systems business. It should be stronger in the second half. It will be stronger going forward, but clearly there's a lot of space to further increase, further recovery in those sectors, with some of them still very much subdued. Really proud of the strong gross margins, and that's been delivered against a background of supply chain difficulties, cost base increases. Managed to pass most of those through. A change in the mix of the product, more software-centric solutions, and our strategy as well of targeting the sorts of projects that we can add more value to. So all those coming together, starting to deliver. You can see the margins coming through. So we're very proud and pleased with that. And based on that, the order book is pretty solid. A lot's in the order book to deliver in the second half. The pipeline of expected orders is really good, really strong, especially going into 2023. So you should see solid performance to continue in the second half of this year, and the trajectory of growth and continued recovery will continue well beyond the second half of this year. Okay, well, thanks everyone for listening. Let's see if they've got any questions.
Paul, Amanda, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated in the top right corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Paul, Amanda, as you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Could I just ask you to read out those questions and give responses where it's appropriate to do so, and then I'll pick up from you both at the end.
Will do, thanks. Okay, the first question we got is from Simon, asking about the roadmap. What does the technology roadmap look like in terms of developments, and are there areas of specific focus? So let me just see if I can jump quickly to that technology slide and move from there. Okay, it should be there now. So we've got a lot of plans in the roadmap. Initially, it's looking at things that productizing things that we've already deployed in the first instance to a number of places. The work in generating our 4th generation product platform was really looking at a hybrid approach to the cloud. It's very important to us that we don't come up with cool stuff and hope people buy it. Our technology development is very much focused around solving customers' problems, and our deep sector expertise, our deep engagement in a number of sectors rather than the general security industry, means that we can see and know problems or requirements as they're coming out from our customers. So the work we've been doing on building the 4th generation platform, it's really important that there's a future upgrade path for all our customers, many of which long term. So many people are sort of stopping and building a new product on a new cloud-based technology. We've not done that. We've got a hybrid approach. City of London, one of the large projects we started doing last year, They have a cloud first policy, so the deployment for them is purely cloud native. Many cases customers are having a hybrid deployment, so there's some physical hardware and some functionality delivered through the cloud. And increasingly we're seeing about our systems are very strong on incident management, and they've been very much control room based. Our strength has been around where operators are using control rooms to proactively manage the safety and security of people and assets. But increasingly, we're seeing the need to take that functionality beyond the control room and include people that are out in the field and other operators into the incident response. So there's been early deployments of those into a number of the high-profile projects I've mentioned, productizing that and making that available to a much broader set of customers, and deploying elements of that at the time and speed that suits them is a big part of what's going to happen going forward. Third-party integrations are really important, always have been important, and a differentiator for our product platform. There are more of those planned. They're integrations, deeper integrations into some specific systems in the certain sectors we're working in. There have been some advances in stuff around transportation over the last year on the back of certain projects. And we've got a couple of roadmap ideas in mind to do some deeper integrations in the casino sectors of some gaming technology, which will become available over the next period. And one thing we have done over the years, our integration into third-party systems has always been led by us. We've delivered the integrations and made sure we've controlled those. We have developed a software development kit and interface for selected partners that will allow us to expand the scaling of our solutions and let in selected third-party customers or partners or developers to develop integrations into our system, which has not been the case before. So those are the key things that we're working on at the moment. We're probably at the full year in the next presentation here, we'll probably do a more significant presentation on roadmap. I would encourage you all, actually, I mentioned that our newsletter and the online webinars, if you want more in-depth idea of what's in the technology roadmap, a lot of that's available on the on our live on our webinars. And so if you sign up to our newsletter or have a look on our website, you can get a lot more insight into that roadmap. But we may do a capital markets day at some point later in the year, and certainly next time round we'll put an expanded presentation around the technology roadmap at that time. Okay, thanks for that question, Simon. None for you yet, Amanda, but next one is from Mark. Would you look at any potential acquisitions to accelerate your growth geographically? I think our answer to that is similar to last time. We would look at acquisitions that gave us market access. So if in the past we've done a number of acquisitions, both in market access and in technology. Technology additions are not what we're looking at. We've got an agnostic platform, that's the command and control platform that would interface to any brand of third-party technology. We're not looking at making acquisitions in that area. But if we could find acquisitions that would help us to enter certain geographies, certain sectors that are interesting to us, then we certainly would be looking at those going forward. I mentioned before, in North America, we're almost exclusively in gaming. Early 2020, we told this community that we would start looking at trying to take some of our other market sectors into North America. That got put on ice in the pandemic, and at the moment, my priority in North America is to recover our position in gaming, where we have big opportunity to do so. But we will look again at opportunities in other sectors in North America, and maybe that's an area where an acquisition would be an attractive way to gain some ground there. Question from Thierry: do you have any recurring or contracted revenues? We are planning to add a sort of recurring repeat revenue KPI into our suite next time round. We talked about this last time out with a few people. And generating more recurring revenues is an important priority for the business. It's about 20% or so of our revenue now is contracted recurring revenues, and a chunk of that on the order book. What we do have, however, is a significant amount of repeat revenue, where from our incumbent position as service partner with a number of end users, we get not contracted but expected repeat revenue as they have sort of replacements, additions, etc. And that's quite significant. So our recurring and repeat revenue together, it's more than half our business. So new projects, new customers, we need for growth, but it is quite significant, the repeat revenue in the business, and it's our intention to publish recurring and repeat revenues in a simplistic KPI way next time round. Another question: the competitive landscape. What does the competitive landscape look like post-pandemic? I think that the answer to that is sector by sector, region by region, different. It doesn't feel massively different in the UK and Europe than pre-pandemic. I think that's probably the case. I think we'll see that changing and emerging more so in North America and Asia as recovery starts there. But at the moment, essentially, the competitive landscape is similar. We're seeing potentially price pressures in some markets that may be stronger than they were before, with increasing costs and pressures in there. But we've never sold or worked on a lowest price basis. We need to demonstrate the value that's offered by our systems. Our pricing is in the high side of the industry, and we demonstrate the value that we offer in that. So at the moment, the competitive landscape looks similar, just looking for the opportunities to open back up as these markets recover and start investing. I suppose very much related, do you believe you can regain the level of turnover you had in Asia in 2019? Or has some of that business been lost to local competitors? It's clearly the case that some business in Asia over a number of years, oil and gas particularly, has been picked up by local suppliers, local markets. We were working on projects in the past in Asia with European integrators who were delivering projects in Asia with our technology. We've been building relationships more with local integrator partners in the region pre-pandemic, and that will continue post-pandemic. So there's clearly local supply pressures in certain parts of the market, particularly in the mainstream security market. But by continuing our focus on the niche sectors that we're strong in and were strong in before pandemic, then we believe we can remain competitive and do really well against local competitors. The strength of the business in Asia in a couple of years pre-pandemic was built around new builds in the casino market, new builds in the leisure resorts. The pace of that has slowed down, so the growth in gaming in Asia will be significantly driven by replacement systems for existing operators in places like Macau and Singapore and other places. But there will be new builds, there will be new projects out there, but probably not the same pace they were in 2015, 16, 17, where we did phenomenally well and had a significant market share of the new builds in Asia during that period. Last question I can see on the screen is congratulations on the National Grid contract. How long do these transactions typically take from scoping to completing? Well, I'll answer that more generally and also specifically around National Grid. National Grid were a customer for a number of years prior to this long-term contract. We'd been deploying systems for them for a few years. So the long high-value contract has been on the back of good performance and supplying systems for 3 or 4 years. We've been able to name them recently. When we first talked about it, was a project for a UK power utility. So that's a long-term relationship that's developed into something that's recurring revenue, contracted recurring revenue, and a long commitment to working together for the future. But I say typically these sort of large infrastructure type projects are typically taking 2 years plus from scoping or initial engagement through to having a project awarded, and to completing can be a lot longer because the deployment cycle can be quite long. So they take some time. When I talk about our pipeline of opportunities being strong and quite full, we define pipeline as pipeline of expected orders. A lot of businesses call pipeline their sales funnel. We call it sales funnel. All the opportunities you can see out there, whether they're imminent or whether you're feeling like they're 90% yours, 75% yours. When we call sales pipeline, order pipeline, it's stuff we really expect to convert and trade. Our funnel of opportunities into the longer term future is clearly much more substantial. And so we have quite a lot of projects in all sectors in that sales funnel going out for a number of years, some of them up to 5 years out. Oil and gas projects, we're often doing front end design for 5 years out from deployment. Infrastructure type projects, typically about 2 years. Casino projects are normally known about for a year or so ahead, though obviously new builds take a while. So that there are some new build projects in Asia that are in our sites, and they're sort of 2025 deployment timescale. So it depends on the sector, depends on the region to a degree. But yeah, a couple of years to get the big projects over the line. But we're definitely focusing on customers and contracts and projects that can then deliver value for a number of years, not a single capital deployment, but that can deliver a revenue stream for a number of years beyond. And that's where the focus is when we're looking at spending 2 years to identify and convert a project. It needs to have a revenue life of 3 or 5 years or so beyond that. Okay, I can't see any more questions on the side at the moment. So,
Paul, thank you very much for that. I think you actually managed to address all those questions from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Paul, could I just ask you for a few closing comments?
Yeah, thanks very much. Well, thanks everyone for taking the time to listen to us today. It feels like we're in a good place. We delivered what we said we would in the first half of this year. We set the bar on the wall and did it. A strong team effort, and really want to thank the whole team around that. It's really a team performance to deliver this half. We should be in a good place to continue that progress going forward in the second half of the year, and really the opportunity ahead of us for further recovery in the markets we operate in and further growth in the markets we're targeting means that should have very strong prospects ahead of it. So onwards and upwards. And, really nice to have Amanda back alongside.
Good to be back, Paul.
Paul, Amanda, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SYNECTICS PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thanks, everyone.